Madam President, I rise in opposition to SJ Res 15. Madam President, this is a misguided resolution. It would overturn an important banking regulation, the OCC's True Lender Rule, and that's a rule that helps give consumers more access to credit. Overturning the True Lender Rule is a bad idea. It would reduce access to credit for consumers, especially those who have the most difficulty obtaining credit. It would stifle innovation, and it would inhibit the functioning of our markets, banking and credit markets, our nation's banking and credit markets. So let me explain why preserving this rule is so important. In the last decade, we've seen financial technology companies, often referred to as fintechs, use technology to revolutionize financial services. And community and mid-sized banks, who often lack the resources to develop banking technology in-house, are partnering with these fintechs to compete more effectively and to offer their customers terrific services at ever better prices. And that's what these partnerships do. They help consumers because they increase competition in lending markets, they lower the price of financial products, they improve credit options, and they expand consumer choice. Now, unfortunately, a patchwork of different legal tests in different courts had made it difficult to predict whether the bank or the fintech partner, when they've teamed up, would be considered legally responsible for a given loan that they would make together. So last year, the OCC issued its True Lender Rule to provide the needed regulatory clarity. And the rule, the simple version of this, is it simply holds that a national bank will be responsible for a loan if it is named in the loan agreement or if it funds the loan, which banks often do when they team up with fintech in these ways. Now, some of our Democratic colleagues have claimed that the rule, the True Lender Rule, allows unaccountable rent-a-charter arrangements, as they call them. But in fact, the True Lender Rule prevents the rent-a-charter scheme. And it does so because it ensures that the national banks are accountable for the loans that they issue through these lending partnerships, and it requires the OCC to supervise those loans for compliance with consumer protection and anti-discrimination laws. Now, other colleagues expressed concern that the rule will trap consumers in arrangements with high interest rates and a principal balance that can never be paid back. But actually, Madam President, that's not possible with these OCC chartered banks, which are the only ones affected by this rule, and that's because a bank is required under the OCC regulation to assess a borrower's ability to repay before making the loan. So if a bank is systematically approving loans via this fintech partnership to consumers who can't repay the debt, they will face serious consequences from their regulator. And that's a lot more protection than what would otherwise exist for consumers. Now, some of my Democratic colleagues claim that the True Lender Law fundamentally changes existing laws about interest rates. In fact, it preserves existing law. For over 4 decades, federal law has allowed banks to essentially export the state law governing interest rates from the home state where the bank is based. So this allows the bank to comply with one law of the bank's home state rather than have to try to comply with 50 different laws of the 50 states in which its customers may reside. Excuse me. And having this single standard allows for a competitive national credit market. The True Lender Rule simply allows fintechs that partner with banks to get the same treatment. It's really not very different than what happens today with credit cards. And may I remind everyone, credit cards can often have high interest rates. So if you believe that bank fintech providers shouldn't be able to export interest rates from the state in which the bank is headquartered, then I suppose you ought to be in favor of eliminating credit cards for all Americans. Well, that would be a terrible policy. It would be a bad policy to get rid of the True Lender Rule as well. Now, I've heard the argument that the True Lender Rule somehow harms low-income consumers. In fact, the True Lender Rule benefits low-income consumers the most by preserving their access to well-regulated bank-issued credit. Absent the rule, uncertainty about which partner, whether it's the bank or the fintech company, is the true lender, it means there'd be uncertainty about what laws to apply to the transaction and whether or not the loan would be considered valid. Well, without the rule, without that certainty, the secondary market for these loans would be disrupted. And again, that disproportionately harms lower-income borrowers. Why is that? Why, it's because banks frequently sell these loans after they are made so that they free up the capital to make the next loan. Banks can issue far fewer loans if they can't reliably sell the ones that they have into the secondary market. Uncertainty, as we would have in the absence of the true lender rule, diminishes their ability to sell into the secondary market. And that means fewer loans are going to get booked altogether. Those that are going to be more expensive, and they will be limited to people of higher credit ratings. Now, this isn't just my opinion. 47 leading financial economists from Harvard, Stanford, and other leading universities made exactly these points in an amicus brief supporting the existing rule. And we've got empirical proof. Studies show that after a 2015 court ruling created uncertainty about the ability to export interest rates to New York, it became significantly harder for higher risk borrowers to get loans in New York. This is not surprising. This is exactly what you would expect. This is what will happen nationally if this CRA is successful in repealing the true lender rule. Now, some of my colleagues want to overturn the true lender rule because doing so would subject more loans to state interest rate caps, they say. But in fact, the more likely effect is that the loans will just never get made in the first place. And that's terrible for the low-income consumer for whom that loan is the best available option. The true lender rule preserves access to well-regulated, bank-offered credit. At the end of the day, Madam President, we need to remember, if the CRA is successful and the true lender rule is repealed, demand for credit won't disappear. The need for credit doesn't go away because we get rid of a good rule. You'll simply make it harder for people who need loans to get them, and you'll drive consumers to unregulated alternatives. Voting in favor of the CRA, which would kill this rule, is also a direct assault on fintech. It'll make it harder for Congress to legislate in this area. It'll make it harder for regulators to issue guidance and rules to promote the healthy competition that fintechs represent. Courts will see this as Congress buying into this completely false notion that fintechs are somehow inherently predatory. They're not. And it'll scare away state legislators from promoting fintech. If you believe financial innovation and competition are good things for consumers, as I do, then you should oppose this CRA. For all these reasons, Madam President, I urge my colleagues to join me in voting against SJ Res 15.